Podcast and folks are going to get started. Hello, fuelers. Hey. Good afternoon. I'm Corey Jo Biddle. I'm the Executive Director for Fuel Milwaukee, and this is our second in a series of 3 financial literacy webinars. Today, we're talking about financial protections. We're going to cover wills, trusts, insurance, and a lot more. So I'm anticipating that we'll have a lot of questions. So let's just kind of do some housekeeping here so you all can get comfortable in the space. As we always mention, if you're not familiar with the Zoom platform, and I'm sure you are now, you probably Zoom every day at this point, but your controls are in your upper right. Go ahead and start playing around with those controls. Make sure that the view looks like how you want it. I also kind of want to direct your attention to the Q&A section of this webinar, which is where you can direct questions directly to me, which I will field to the panel. Panelists can see them too. And then you can go in the chat and interact with the other participants on the call today. So we had about 100 folks register, so we should have some good potential conversations, and other folks have questions and ideas and resources that we can share back and forth. So go ahead and get comfortable with the technology, and in the webinar, we are family here. We are family here, right? So speaking of family, I'm gonna kick it over to Gary to introduce the team, and then they'll get us started with the topic. Hey, Gary.
Hey, how are you, Corey Jo?
Doing good.
Good. Are we ready to go?
Yep, go ahead.
Okay.
You can introduce, let folks know who's from the team, and talk to us a little bit about money management educators. Tell us what you guys are all about and who you are.
Sure, happy to. So you saw the amazing photographs of Tim and I. Money Management Educators is a financial education organization. We're based out of Chicago and Florida, and we are a not-for-profit education organization, which means these workshops are all about education. No selling, no products, no strategy, or I shouldn't say strategy, no services. It's all about you. And so to that point, if I can, to that point, we want to make this about you, and we want to make it have impact and make a difference. So look, we've all attended webinars. I mean, I've had my share of them as well. And we all know that they're oftentimes just a place where we can like put some information up on the screen and come over here and do my emails. Hey, I want to encourage you to try to stay with us because you never know, you might catch 1 or 2 little tidbits that can really change the way you look at finance, the way you do finance. And that's what we're all about, is trying to help you find just that 1 or 2 little nuggets that can make a difference. So hang in there with us, and let's see if we can't make a difference for you guys. So we're going to dive in today. Our financial foundations are all about the infrastructure. You know, it's great to have a 401k. It's great to have an IRA. But at the end of the day, if the stuff I have supporting it isn't in a good place, and we get a crack, which Tim will actually address that, you get a crack in the foundation of your house, eventually that leads to very expensive repairs, if they can be repaired at all. So we want to go through the fundamentals and maybe take a different spin, a different look at how we're going to do that. One of the things that Tim will talk about at the end is in the workbook, the handout that we have, you can grab it off the chat line if you didn't see it in the email today, but some of you got it on the email. In that workbook on the last page, Andrea, are we going to have is there the link in that one, or is that one live? And you're on mute. Unmute. Nope, that would be the camera. So there is still muted. So there is a Q&A at the end of it.
Yes, and it says click here to get to the response form that we're looking for.
Great. Awesome, thank you. Sorry that was so hard for you. But if you can, at the end of the workbook, it says click here. I want you to know what's there because you don't want to click it right now. But at the end, we'd like to ask you 3 questions, but we also want you to know that we, Tim and I, are going to avail ourselves of some free time that you can sign up to have some one-on-one private education with Tim and I offline. It's all done on Zoom. We'll talk more about it later, but we want to make sure you know that you can sign up for that. A lot of people missed it last week. They didn't realize that. They had questions, and we want to be there to help out and make a difference. So we'll talk more about that as we get there. Step one in building good foundations is understanding and knowing where your money's going. Guys, we all have to admit it. I don't care how much money you earn. If you earn $20,000 a year, if you earn $200,000 a year, the end game is you have an employer that you have decided to trade your time with for money, and they're giving you a lot of money. And the end game is that money is coming into your checkbook. Here's my question for you. Where's it going? Because if there's not a lot of money in your checkbook, you let it out. So the question is, where is it going? And more importantly, who's getting your money, and is it okay? For example, it is not okay to keep spending $100 and $150 a month for cellular service that is now available for $50 a month almost anywhere you go. So you got to look at things like that. So we're going to take a look at cash flow. I want to show you a little trick that we developed that really helps people take a second look at their cash flow, and we call it controlling cash flow. And by the way, anybody that wants this spreadsheet, all you got to do is let us know on the response card. Just let us know you want the spreadsheet, and we will be happy to shoot that to you or make it available when you have a education session with Tim or myself. Guys, the trick today is we got to know where our money's going. We know how it comes in. So we want to track that a little bit. And I know we've all been told we got to track our money, and it's really boring. And so let's have a little bit of fun with tracking the money. There's a number of apps out there that can help you keep an eye on where your money is going and when it's coming in, and it'll do it real time. So what we want to do is, I'll show you those apps in a second. What we want to do is get the dollars coming in and identify that dollars are coming in are correct, number one. I'm assuming we're all getting our correct paychecks. But then start writing down, start tracking where the money's going. And again, some of these apps can actually do this work for you. But on the spreadsheet, we just set up a simple example. And I'm going to zoom in on that section. But this is where you want to be able to keep track of your rent, your mortgage, your taxes, your heat, light, utilities, dining, all those things. Dining, let's get back to spending money on dining. All those things that we spend money on, we want to identify all of them. And by the way, don't cheat on the list. It's your list. No one's looking at it but you. But let's see where the dollars are going. And then the next step is we want to have you highlight the core expenses, okay? Highlight core expenses. So what are the core expenses? Here's what I think core expenses are. You just lost your job, and so did your spouse. And the two of you are standing on a street corner, and all you got left is your stuff. So what does it cost to keep your household alive until you get your next job? So heat, light, food, rent, things like that. You want to track those items and highlight them. Because here's the thing, if you do this right, you're going to find out your core expenses are a whole lot less than you think they are. Cell phones, we got to have them today, but do we have to have the latest iPhone? I would argue probably not. Personally, for me, I skip a generation all the time. But do we need the most expensive package? On the cable, do we need the most? We got to look at these things and see, how do we keep each other fed until we land that next job? Highlight those expenses. I call it highlighter time, and add them up. And when you add them up, what you're going to find out is they represent a much smaller amount of your paycheck than you think they do. Now, add up everything else. And, you know, we've all heard that term over the years. Oh, yeah, that's discretionary spending. No, that's discretionary spending. I would argue that term is wrong from the word go. It's discretionary income, and how we spend those dollars is what's really critical. So add up everything else that's left over and come up with that number. And let's say that number is $2,000. Now you know what your discretionary spending is. And now you can keep an eye on it if you're using a smartphone like I do, and one of these apps that are real time feeding the app with where your money's going. I mean, your Starbucks order from this morning will be in your phone before you get to work, when we get to work. And that way you can keep an eye on dollars going out, so you can ask the big question, is it okay? Is it okay for that money to be going out where it's going? And when you start chopping away at those kind of numbers, and you know what your total discretionary spending is every month, you can track it. You can watch it on a real-time basis. And now you can find excess spending without probably changing lifestyle. And you can start to identify extra dollars that you can start to put to an emergency fund, to paying down debt, to putting to your investments, or maybe even a little bit of all of it. So hit those highlighters, find out what your core expenses are, add up everything else, and find out what your discretionary spending is, and find out where it's going. So check this out, and maybe you want to take a screenshot of this. These are a couple of apps that you can use to help track money real time.
Yeah, Gary, can I add one thing to this that
Sure.
from my experience, I've been doing this for 10 years now, and you know, most people fall in one of two categories. We're either a spender or a saver. And I really think everybody is either or, and we all know what we are. So some people that I meet with, they're just naturally have they saved their allowance when they were 8, and they've done it forever. And for other people, we have to fight a little bit harder to kind of form some of those good habits. A lot of these apps, for those people that, like, you know, hey, there's some people that you could send me a spreadsheet and I'm never going to really fill it out, or I'll fill it out and 3 weeks later, it's just like, whatever. So, you know, the apps, the really nice thing is they can drive a lot of those, you know, the record keeping and stuff that people don't want to do. Like, You Need a Budget is one that's really popular right now. Mint has been around forever. One like Digit actually does a really good job of, like, you know, and this depends how much you want to let an app have access, but it can track your data and spending and give you reports that could actually help look at, oh man, I spent like $300 on Ubers this month. You know, not that anyone's doing that right now really, but you know, we've all had that where you get one of your Grubhub printout and you're like, oh my God, you know, so a lot of these apps will help itemize that stuff for you. Cause like some people are spreadsheet people. Some people are just like, don't want to touch that stuff. So you have to kind of know yourself. If you're also looking for budgets, like templates, you can go on Excel and just type in budget and search, and like hundreds of them will come up. So that's like some really good places to start. You know, if one budget doesn't work for you, you kind of have to look around a little bit. But the apps now can really tie everything together so you don't have to do a lot of the work yourself.
So Tim, which app was it that you're using?
Right now, I don't use any of the apps really. I just track my spending, but I've used Mint in the past. And that's the one I've had the most experience with. You Need a Budget right now is one that, like, on most of the ratings, like, people love it, but it's a little bit more expensive. It's about $80, $90 a year, I think, for that one.
Yeah, and the Mint is the one I've been using. The Mint is free. So, but that's going to just track data. It's going to do budgeting for you, budgeting in the sense that it'll tell you where you spent your money. So, but that's a good app to use, and it will aggregate more than one account.
Yeah, and
more than one account.
The other thing that to the cash flow point and that you were made is, what a lot of times when we get paid, the first person to get paid is actually the IRS, right? They take their cut before we get our check. Right. Then what most people tend to do is, like, all right, I'll pay my bills, spend some money, and hope to save a little bit at the end of the month. Like, there's $100, cool. Well, what really, like, a way to start thinking about it differently is, like, pay yourself first. If you want to save $100 a month, put that away, and that money should be away before you really start even paying down your bills or going out. So sometimes we try to back into how much we want to save, where really, if you could start setting that aside and knowing those numbers, like how much it actually costs for the things I need, is important to help you determine how much you could really start putting aside a month. So,
and we've all heard that, right? Pay yourself first. We've all heard that for years. But look, the reality is you've got to do it. You've got to put that plan together to make it happen. It's not going to happen by itself. All right. Good points, Tim. All right. So that's mastering cash flow, if you will. End game, to Tim's point, everybody works a little bit differently. Figure out what works for you, but put a plan together. Gathering money will never happen by itself. It just never does. So let's talk about debt a little bit. We all know debt is a bad thing, but you know what debt does is it robs us of a lot of free cash flow. So the sooner we can get rid of it, the more free cash flow you're going to have. And I just
and to the point of debt is a bad thing, though, one thing to remember is there is good debt and bad debt. There's a very big difference. And having a mortgage, sure, that's debt, but that's debt that you're building equity in something long term. A credit card at 22%, however, now, I mean, we all know that that's not the same thing. So there are, like, we want to make sure that what kind of debt we have, interest. So there is a distinction there, right, Gary?
Absolutely. And you made obviously a big glaring point. There's this short-term debt, unsecured debt, you're paying even 10% would be too much, but 10, 15, 20% for some of these credit cards. Those are the ones that have to come to an end. We're all going to have mortgages, we're all going to run into that during our lifetime. And, but the short-term stuff can be really killer. So all we want to do is show you one tip, trick, if you will, to try to get rid of some debt. But I think understanding debt first is really important. Debt has two components, and they're very critical. The first one is mathematics. I owe this much. Here's my charges. Here's what I'm paying back. It'll take me, 5 years to pay it back. That's mathematics. But there's also another piece to it, and I would argue goes to all of our finances, which is emotion. Emotion drives everything we do, and there's good and bad emotion. Nobody likes looking at credit card bills, but how much do we enjoy paying that last payment off on the credit card bill and really feeling like we accomplished something? That's a great feeling. So there's a big positive feeling or emotion that's tied to debt. The emotional component is the piece that's going to drive it. Just trust me on that one. That is the way it's going to work. So step one is organize your debt according to the balance and not so much the interest rate. Well, yeah, but I got one that's 23%. It's only $1,000, but hey, it's a big interest rate. I know, but you might have another one that is a whole lot less at a lower rate. A whole lot more at a lower rate. It may be better to just get the small ones picked off so that you really feel like you're making headway, you're accomplishing something. That emotion will drive you to get the next one paid off, and I'll show you that in a minute. So organize your debt according to the balance, and then we have a thing we call the snowball approach. You've heard of it before probably, but if you haven't, it's a really simple concept. But use the snowball approach to pay it off, and then create attainable goals. Don't don't lean into $20,000 of debt and say, I want to have it all paid off by the end of the year. It's not reality. You probably won't be able to. So set a timeline that's going to work. And then, of course, celebrate your accomplishments. So let me just build it out for you and just show you kind of how we do this. So this is our fictional debt. You can see that we've got a credit card that is credit card number one that has a $1,000 balance. We have an auto loan that's got $12,000 balance. A credit card number two that has a $9,500 balance, and a student loan for $2,000. And by the way, student loans are kind of their own topic a little bit, particularly right now. And we're going to be building that into what is it? Our next workshop, Tim? Or yeah, the next
most likely the next workshop. Yeah.
Yeah, we're gonna carve out a little bit of time and talk about student debt and some things that are new and that are going on with student debt. But so there's my student debt loan. I got $2,000. So here's my debt. So I'm going to ignore interest rates for a little bit. But I do want to go to this minimum payment column. And I'm going to get myself a little spotlight so I can show you. So we're going to go to the minimum payment column. And step one, before you even look at this, is look at your budget, look at your cash flow, and see if you can find an extra $100, $200, maybe even $300 in a month that you could throw on top of one of these to start paying it back to speed it up.
So here's one point to that. What we see a lot of people do is, like, if I have four bills there and I have another extra $150 a month, I'll take that 150 and divide it up and put a little bit extra towards every one. And that is not really going to be the most efficient way to get these down fast. So you want to really take a more focused approach and focus on one at a time if possible.
Exactly. And so if you can find a couple extra dollars in your budget, and in this case, I think we used $300 for our sample. So there's our priorities. We're going to get the little one paid off first. Then number two, the student loan, because that's the next small one. Then three, and then four. So now you got a little idea of what we got in mind. And so we're going to start with number one. We're paying $80 to it. But what if we found an extra $300 in our budget and we could bump that up? That's a great way to start. So take a look at your budget, see if you can find an extra few dollars, add that to the 80, and now I'm paying $380 to a $1,000 credit card bill. I'm going to pay this off in about a little less than 4 months. I'm going to get that knocked off. The trick is what happens next. So now I pay that off. I take the $380 and I come down here to my second one, which I'm only paying $100 to, but I add the $380 to that $100. And now I'm putting $480 toward a $2,000 bill. Again, I'm going to knock that out in about, 4 months, 5 months? I'm going to get rid of that thing pretty quick. And now I have $480 that I can roll up on top of my $150. And that means now I'm sending $630 a month to this credit card bill. And here, it's going to take me a little longer than a year, but I'm going to speed that one up and get that paid off pretty quick. Now I've got $630. I'm going to roll that on top of the $250. And now I've got nearly $900 that's going out to a $12,000 auto loan. And now I can really pummel that one. It's going to take a year and a half, but I'm going to get that one paid off a whole lot quicker than the original term. And if that makes some sense, that's called the snowball approach. And when you start paying off credit cards like that, you're going to feel energetic about getting them paid off. And of course, when you get them all paid off, celebrate a little bit because you worked hard at it and it's worth a little bit of celebration. There is one more trick to this though, and that's when you're paying off debt. Studies have shown that unless you pay off debt and save at the same time, you're pretty likely to go back into debt. Because if I get all my credit cards paid off, but I don't have anything in the bank and I blow a tire on the car, I'm looking for a credit card. So make sure you're saving a little bit at the same time as you're paying off this debt. And I think you'll be a lot happier with that strategy. Okay, where are we here? I think it's foundation time. Tim, what does this picture mean?
Yeah, so here we're going to talk a little bit more about like the pieces that go into the foundation. And for those of you that were here last week, and Gary, I don't know if you can give me control of that there.
Absolutely.
For those of you that were here last week, we're going to bring up this slide again where, all right, here we have the financial house, and we're just going to bring up essentially the building tool, the ingredients that we need to build a foundation. So this is where we're going to talk about wills, insurance, savings, all that fun stuff that everybody wants to talk about. And when we're talking about the foundation, sorry, I'm just clicking all this stuff up here. What we're really talking about is asset and income protection. That is really the foundation of what we need to build our financial house, to have aggressive investments, etc. So last week we went through some rules of thumb here. You can kind of just take a look, and then we're going to take a little bit of a deeper dive into each of these topics. So like we just said, we're really talking about income protection and asset protection here. The big piece I think a lot of you will miss is the income protection piece. And, insurance is definitely something that I find people don't want to talk about. Another way to think about insurance, instead of calling it insurance, is just to call it leverage. And, it's really about handing off a lot of the risk that we face every day and using a small amount of dollars to get leverage from a big company in case something bad happens. So first thing we're going to talk about real briefly is just medical insurance. Most of you guys have medical insurance through your employers. The biggest things that I think we really need to know here is like, what are our deductibles? And then do I have any overlaps if I'm married? I see this all the time where like people will have benefits with them and their spouse, and like they couldn't even use them all because of all the overlap they have in their plans. So you could have double coverage, and you want to make sure you're not overinsured too. Also, one thing, I had a client a few years back blow out her ACL playing kickball, cost her $5,000. And a lot of that came down to like, she didn't really understand how her therapy worked in her plan, how a lot of the deductibles work. So there were some missed opportunities. So just know what you have with your medical insurance. Right now, the next thing I'm going to talk about, long-term disability insurance. This is something that most people get through their employer as well. If you're self-employed though, all these benefits are something you're going to have to get on your own. So the thing about long-term disability, most people, when they think about disability, they think about a tragic accident, about someone getting hit by a car or falling or, something like that, a cataclysmic accident. But in reality, only 10% of disabilities are caused by an accident. The number one leading cause of disability is actually cancer. So diseases, soft tissue issues, those are the things that really cause people to miss work. If somebody becomes disabled, typically their expenses are going to go up. I don't become disabled and all of a sudden have less expenses. So, it's something to be aware of. If you're paid commission or bonus by your employer, that is not typically going to be covered by your disability. I see a lot of people right now making, 50% of their income is commission or bonus. Well, that means that they only probably have about 25 or 30% of their whole salary covered by disability insurance. So you want to be really aware of that. The big thing about most of these benefits is do you know what you even have? Like if you don't know, if I was like, well, what's your long-term disability benefit at work? If you're sitting there scratching your head, I mean, that's the first place to start, is know what you have. And one way to think about this, an old insurance thing is, like, if you had a machine in your garage that was printing $50,000 a year, how much would you insure it for? And, that's essentially like, you're the machine. Your ability to get out of work every day is your greatest asset that you own. So just make sure that you understand how you're protecting that. Life insurance. So this is where we're seeing a ton of questions right now. And when you're thinking about life insurance, there's really 3 questions that you have to answer when you're considering life insurance and how much to get. And the first is, how much? What do I need? And that number is going to be different for everyone, but for most people, it's between 10 to 20% of, 10 to 20 times your income. So if you make $100,000 a year, you probably need $1 million to $2 million of coverage minimum. So how much do I need? Then the next question is, what kind do I need? And we're going to talk about that. Go ahead.
Before you get into that, 20 times sounds like a huge amount of money. Can you explain it just a little bit? Because that sounds enormous.
Yeah. So when you're talking about how much insurance do I need, most people at work will have between 1 to 2 times their salary. That's the typical kind of standard amount that people have at work. If something were to happen, what I see a lot and hear a lot is, well, it's okay. My spouse will be okay. She works or he works. And the reality is that if something were to happen, would you want your spouse to continue working, or to have the option to be able to stay home and raise your kids in the hardest time of their life? So you have, number one, replacing income. That's the first piece. The second piece is, then, do you have a mortgage? If you have a $300,000, $400,000, $200,000 mortgage, then you're going to want that covered by the policy. So now we have income, we have expenses. College, what about college? So, I mean, how are you going to pay for that if something were to happen to you? Once we start adding up all these things, $1 million, it's not real hard to get to that 10 to 20 times our income that we need to provide the benefit. So, what kind we're going to talk about here in a minute. So the next thing we're going to talk about is kind of what the 2 kinds of insurance, and the differences in kind of pros and cons of those. So, term life insurance. And one thing I want you guys to remember when you're talking about life insurance is, if you hear somebody ever say, like, this kind of insurance is bad for everyone, or this kind of insurance is good for everyone, that just is not reality. Everything has pros and cons, and we're going to go through that right now. So term insurance is what kind of the most common insurance that we see out there. And the advantages are that term insurance, it can be really, really affordable, especially early on in your working years. Mm-hmm. Most people, if they do get term through their employer, they'll usually have like 1 to 2 times their annual amount. And the term insurance, you can get term insurance now and then upgrade it later to a different time if you want to. So term is like, you buy insurance for a specific need for a specific period of time, and it's typically very affordable. The disadvantage is that as you get older, it gets a lot more expensive. Yeah. So as I'm getting closer to retirement, the cost of term insurance can be really high to the point where it doesn't make a lot of sense. It does not build any equity. So anything that I put, the only way that I get anything out of a term policy is if something bad happens to me. Right. So there's no equity there. it may not be, it may be renewable, it may not be at the end of the term, but if it is renewable, the price is typically going to be at least 10 to 15 times as much as you were paying to start that policy. And then if you have a policy at work, if it's term, you can't take it with you. So if I get another job, I'm going to have to hope that they have some insurance there. So a lot of people will get this outside of their employer. So that's term insurance. The next type of insurance is permanent life insurance. And permanent life insurance remains in force until the policy matures, or typically until you die. So you have the policy for your whole life. And you might have heard it called like whole life or universal life, but for purpose of this workshop, we're just going to call it permanent life insurance. The advantages are the premiums are never going to go up. They're fixed. So if I start a plan, I know what I'll be paying forever. I can usually pick a period of time. If I only want to pay for like 20 or 30 years, you can do that. You are going to have the coverage until you die. So if you want to have life insurance when you die, the best option is typically permanent life insurance. And permanent life insurance policies accumulate cash that you can use while you're alive. And the cash that you pull out will typically have some tax advantages that you don't have to pay income tax, just like a Roth IRA when you pull money out of it. So there's a cash value and a savings component that you can build equity inside of a permanent policy. So term, if you think about it, is kind of like renting. Like, I have this policy, if something bad happens, I get something, but I'm not going to build up any equity. Where permanent life insurance, it's like you own the policy. The disadvantages are, in the early years, you typically have to pay a little bit more for the same amount of coverage, and you commit to funding for 5 to 10 years usually. And it's sometimes misrepresented as an investment. It's not, life insurance is not invested in the market typically, although there are ways you can do that, but we're not going to get into that today. But you're typically, you may earn some dividends or some interest from an insurance company, but it's not invested in the market. So you want to be really sure if when you get a permanent life insurance policy or a term policy for that matter, the company you work with is really, really important. What is their history? What kind of a company are they? Are they private company or public? All those things make a really big difference when it comes to how life insurance policies will grow. So those are kind of the basics. The fact of the matter is, a lot of people have both, where they use permanent insurance to have some life insurance forever, to build some equity, but then have some term as well to cover any additional needs they might have, especially when they're younger, in their earlier working years where they might have more debt. So if you're like, I don't know, like the big problem that we see is like a lot of people just don't know what they need. So, what I would really recommend is talking to someone about this. It's hard to call a 1-800 number and get a really personalized plan when it comes to life insurance. And if that's something you have questions about, Gary and I would be happy to talk to you after and at least kind of give you some ideas about what you should be looking at, the questions you should be asking, all that stuff. The last thing I'm going to talk about with life insurance is just a couple statistics I found really interesting. 50 million people feel they need more life insurance coverage. So 1 out of 5 need more life insurance coverage. And that's the people that think they do. I guarantee you there's millions more people that think they're okay that probably aren't if something were to actually occur. 63% of Americans aren't buying life insurance because of the price, but 80% think life insurance is more expensive than it actually is. That was kind of one that just, I couldn't quite wrap my head around that. It's, we actually have a wrong idea of how much the price is, and that's prohibiting people from getting information and sitting down and figuring out what their needs are. Life insurance companies, as people have actually lived longer, the price of life insurance has actually decreased. So people are healthier, living longer. It's really affordable to get coverage right now. So with that, the last thing we're going to talk about is, real briefly, long-term care insurance. This is something we talked about a little bit last week. 50% of people age 85 or older are going to need long-term care, meaning nursing home or in-home care. Long-term care insurance, the thing that it really helps with and provides is it allows people to be care coordinators for their loved ones instead of caregivers. So, if I have a long-term care insurance policy, that means that I'm going to have a lot of resources available that the insurance company will provide. I'm going to have money available, and I'm not going to necessarily have to be there 24/7 if a family member needed something. So it really allows people to, if something happens to family, then, we're going to take care of them. But how we can do that, long-term care insurance can make a big difference. So just being aware of this, if you have people, a lot of times people in their 40s and 50s, this is where this really starts to be something that they're looking at to address. And just make sure, you're getting the information so you can make informed decisions.
I was just going to real quick say, we got about 4 minutes till we get to Q&A time. But when my mom was sick and needed help, we narrowed it down to 8-hour shifts. And in the course of a month, there's 88-hour shifts. And that was just completely overwhelming. But that was one way to look at it too. So.
Yeah. And with that, we're going to kind of wrap up here. So with estate planning documents. And with estate planning, we talked a little bit about wills and trusts last week. And the biggest question we get is, do I need a will? Do I need a trust? And, the answer is it depends. But even if you haven't done anything and you're just what we call like passively planning, if something happened to you, the state essentially does have a will for you, and your assets would go into court and a judge would decide where they're distributed. It just might not be what you would have wanted. So if you want to have a say over where your assets are directed after you pass away, if something were to happen to you, then you need to have a will. So a will is what a will is a document that will direct where your property goes after you pass. A living trust is actually a trust holds ownership. So if I have a house and something were to happen to me, well, my kids are 7 and 9. That house couldn't go to them. But if I had a trust established, the house could be owned by the trust, where somebody could then manage and distribute that asset eventually for my children. So
Tim, can I interrupt you? I just want to ask a question about that. I think when people hear trust, I know certainly when I hear it, I think of an organization or a big conglomerate or a bit like a huge millionaire estate. Just a normal everyday person can have a trust. That's right. And
and a lot do, because if I have a life insurance policy and if I have minor children and something were to happen to me, they can't just give that money to a 9-year-old, right? So, but if I had a trust set up, then that life insurance benefit could go into the trust and be distributed to my children for their benefit by someone of my choosing. So if you do not need to be a millionaire to have a trust. And if you're like, well, I have a house, I have kids, I have assets, life insurance. Yeah, you're in that gray area where you at least should probably sit down and have a consultation with someone. if you're like, I don't know where to turn for that, that's something me and Gary can help you out with. Typically, most attorneys who do like wills and trusts, they'll have a consultation with you for free. They're going to charge you if you get some work done. But getting a trust or basic will isn't an exorbitant, it could be anywhere from $500 to $2,500, depending on how complex it is. So it's not an exorbitant, cost usually, and it's usually a one-time expense as well.
Tim, on the trust topic, all I want to say is this: the thing a trust does is it'll help you avoid probate, and it'll give you immediate control over assets in the estate. Even if it is just mom's house, you immediately control that asset as opposed to waiting for it to go through the court systems. So
yeah, I've seen that a lot with clients and people I talk to who are in their 50s and 60s and will have a parent pass away. And if there's no will or documents, then that house eventually will make its way to them, but it's going to have to go into probate first. And it's a longer process. It slows everything down. So, if you own a house, you're definitely in that, like, okay, I probably want to at least find out, and make an educated decision about this, and the fact of the matter is, and I talk to Gary about this all the time, like, this stuff should be taught in high school. Like, we all, 90% of the people in high school right now are going to probably have a 401k at some point in their life, or need a will or life insurance, but we're not teaching them any of this stuff. So if you're watching this and you're like, I don't know, that's why we make ourselves available one-on-one, because this is going to lead to a lot of questions for people. And, these workshops, sometimes people leave with more questions than they had coming into it. Well, so we want to make ourselves available after, if you want to get some questions more personal to you. To
your point, though, we got questions kind of building up, but we pretty much wrapped.
One more slide here, and then we can get to the Q&A. So last slide, directive documents. If you get a will, it's gonna typically come with directive documents, and that's all that is your medical and financial powers of attorney. So if something happened to me and I was in a coma, who's going to be the person making medical decisions for me or financial decisions for me? And then provisions for your children. If you have children and you don't have a will and documents telling the court where they should go, and you have a bad relationship with your immediate family, or, that is out of your control. So, it is of the utmost importance to get these documents if you have kids, and you can do it very, very affordably online at some websites like LegalZoom, and there's got to be some other ones at this point as well. Also, check with your employer. I've seen countless people have companies that offer benefits where they can get a will, they can get a basic trust, and they have no idea that this is a benefit at work. So make sure you check to know if that's an option for you. And with that, we can kind of get into some question and answer. Oh, last thing, this is in the workbook, and this is really important page here. This is kind of like all the boxes you need to check. And so if you're looking at this and you're like, well, I have like some of this stuff, but I don't really know what I have, or I haven't taken this policy out of a drawer in 10 years. That's the kind of stuff where we could sit down and help you at least understand, what you're missing, or if there's some pieces of the foundation with some cracks in it that maybe need to be repaired at this point.
That's great. The summary document, I was just going to ask about.
I'm going to go back to that.
Awesome.
Oh, sorry, Gary, can you take over and back that up if people want to look at that for a few more minutes? Maybe leave that up while we do Q&A.
There's a little fill in the blank piece of that in the workbook as well. And then the other is the last page of the workbook. While we're going to leave this up on the screen, but on the last page of the workbook, there is a item that says click here. That will take you to our response page. We really would appreciate if you guys would take 30 seconds. There's 3 questions on there. But that's also where, if you want to have a conversation with myself or with Tim, that's where you're going to go to say, yes, I'd like a personal education session, and then give us your email address so that we can get you the information you need for that meeting. Make sure to hit that last box at the bottom that says, I got it. That's the hold harmless. We got to have that backing so that we can hold the chamber harmless in case somebody starts trading pork bellies and loses all their money. But then just hit the submit button, and then we'll get all that information. And Andrea is going to help keep an eye on that while we do some Q&A.
Okay, so as we transition into that, let's bring Andrea back into the conversation. She's also a part of the MME team. She'll be pulling out questions from the Q&A and the chat. And actually, if we can go to unsharing the screen, that way everybody can see all of us. Right now, they can only see the one person talking.
You betcha.
And then we'll start to sort of pull in some questions. Thank you so much for that last summary document. I think it's overwhelming sometimes for people to know, am I hitting everything? And that was a great sort of a checklist. Andrea, are you seeing any good questions from folks that you want to raise?
Sure. We can go back to somebody had a question. Nicole had a question about buying long-term care. And she said she believes it's discouraged when you're young because she believes it's expensive. But then as you approach an age, you might need it. What's right age, or what do you go by?
A lot of companies now, they're not even like giving or writing policies for like really younger people under 30 or 40 even. A lot of companies are kind of going to, you have to be like 40 or over. So most people that we see really start to look into this in like their late 40s, early 50s. It really starts to become more kind of top of mind. And with long-term care, it's kind of like with college savings. They always say it's about having multiple accounts that you can use. So you're probably going to need to self-insure a little bit, maybe use some of your assets. And then, hopefully you could leverage with some type of long-term care protection as well.
I think also taking into account your family history, and if there's any concerns that you could have something similar that grandma had or mom has, you may want to get in front of that. I would also encourage you to maybe chat with us a little bit, tell us more about your story, and we can give you some better guidelines on that.
Okay, great. The next question is about a will and living trust. Do you need to go through a lawyer? I know you mentioned some online places like LegalZoom. Or is a notarized document enough?
Yeah, I think if you have a fairly simple estate, technically you can write it out and have it witnessed, and look, that's a legal document. That said, the more complex your estate gets, probably the more details you're going to need in your plan, and you better have a proper will and or trust. I don't know anybody, Tim, I don't know if you know anybody. I don't know anybody that tried to do a trust on their own. But wills, certainly LegalZoom. You can buy software at Office Max.
If you just are like, hey, I need a will, like my powers of attorney, and then the guardianship documents, you can get all that done online. And it's not, and it's not really a very hard process. It's very affordable. If you need a trust, I would recommend going to see an attorney for sure. You don't want to get those documents wrong. Mm-hmm. So go see a professional. Most consultations, like I mentioned, like an attorney's not going to charge you to come in and just talk to them about what you have. And I think I saw a question about cost. It's really variable. I could tell you, for me, it was around like $1,500 for me to get everything with a trust. And that's what I see is usually about $1,000 to $2,000, ballpark is kind of the jumping off if someone needs like a trust. If someone just needs a will and those documents, you're usually between like, $300 to $500 or something like that,
with
if
an
you
attorney.
Get it from them with an attorney.
And let's go to the other extreme of that. I think LegalZoom, last time I looked, was around $75 to do a will and powers of attorney.
Yeah.
Quicken Willmaker software, you can buy at Office Max. I bought it 5 years ago for $50. You know, as simple as it is, like the one question, no children, got a couple of nieces, and by the way, a favorite financial educator. Just saying. Anyway, you could probably pick up LegalZoom or pick up the software and you'd be good to go.
Yeah, and make sure your beneficiary designations are correct, because it does not matter if that will says you want your 401k to go to your nieces if you have it going to a friend or a parent. It's going to go to whoever that beneficiary designation says, regardless of what your will says. They will uphold the beneficiary designation.
Can I, Tim, just add on to that? Guys, this is a really big legal point. In lots of cases where we've seen divorce, the spouses forget to change their life insurance beneficiary. Beneficiary is the order of law. So if you say in your will, I want everything to go to Andrea, but you forgot to change your life insurance, it's going to your ex-spouse.
Yeah. If you had kids and you used to have your sister or your mom on there and you haven't, I see that a lot where somebody maybe used to have somebody, a parent, and they haven't updated it. So make sure you update that stuff.
Right.
Okay.
Let me, Andrea, take the next question, but I want to jump in. I see this one, I think, quickly. Can you guys speak to this? Somebody wants to know, for someone who is older, say 60, 65, getting a permanent life policy, is it worth it or is it too late?
It really depends a lot on the person's health. You know, it's going to be much, much more expensive the older you get. But I mean, does the person just want to have, do you want to just have some life insurance? Are you looking to build equity? So it really, but I mean, to be perfectly honest with you, I don't see a ton of 60 and 65-year-olds where it makes a lot of sense, or who even can really get a life insurance policy because of, you know, the health conditions or whatnot that we see a lot of people have. Also, life insurance companies are they're being a little harder with people that are over 60 right now, even over 50. So with COVID right now, we are seeing, you know, much, you know, with younger people, it's not been quite as dramatic, but life insurance companies are being very cautious right now.
I think the 60-year-old question is going to go to what's the purpose and what are you trying to accomplish? But the answer is yes. I have, unlike Tim, I have had a number of 60-year-olds just lately who have taken life insurance for whatever reason and gotten approved. I have a 68-year-old that just got approved. But for him, it was to serve a certain purpose. It was worth it to him. It worked. Depends what you're trying to do with it. But I would definitely have a conversation with one of us about it. We can try to help you sort it out a little bit.
Okay. And also related to that permanent life insurance, you mentioned that you can pull out money out of that if you need to. And if you do pull out money out of permanent life, do you have to pay it back?
Not necessarily. You have an option to, when you pull money out of a life insurance, they give you a couple different options as far as how to do it. One of those options is to take money out as a loan, which gives you the option to pay money back in, but you can also surrender money out of there that you cannot pay back in. Right. So there are some different options there. But you don't have to pay it back either. So a lot of times with life insurance, you can take money out of a policy with the intention of never paying it back. Because then once there is eventually a death benefit, that death benefit can pay back if there's loans against the policy. And so there's, you don't, just because you pull money out of a life insurance policy and it's a loan, that doesn't necessarily mean you ever have to pay anything back.
And do you have to pay tax on the money you take out of it?
You don't have to pay tax on the money. So life insurance is a slow and steady growth type of asset. It's not something that, you know, is quite as exciting as when we see our 401k returning 30% in a year. And the way I describe, to a lot of my clients and people I work with is, your investments are your castle, your 401k, your stocks, your real estate, all that stuff. It's your castle, but your life insurance is the moat around the castle. That's your protection piece that makes sure, look, if all else fails and I still have this life insurance and it's a safe asset that you can access either through loans or just doing surrenders where you cannot pay the money back then.
This is awesome. It was perfect timing. Andre, do we have another question? I think we got time for maybe one more. We'll go a little bit over.
There's one more. And should you invest aggressively with your Roth IRA?
Again, it depends on what all your other investments are. But typically, yes. Like if you're younger and you have it is called an IRA, is individual retirement account. So that account is intended for retirement. If you're young, 30, and you have a long time horizon, that means I want my money to be more aggressive. I can deal with more of the ups and downs of the market because like in last workshop we saw, over a long period of time, the market is where the bigger returns are going to be. So typically if you have a Roth IRA, then you're younger, you're going to be more aggressively invested in it. But as people get older, closer to retirement, Roth IRAs can be used to hold all types of different assets, whether they're aggressive or safe. So it really depends on your age. How long do you have? What other investments do you have? All those types of questions.
Yeah, and your age. Big time.
Yeah. How long do I have before I retire? If you're 30, then typically that Roth IRA is going to be invested pretty aggressively.
Great.
But if you're 50, that may not be the case.
Well, I think this was awesome. We are just a little bit over our time. I think we answered most of the questions. Yep. And you guys are getting a lot of love in our chat. Folks are saying it's very helpful. Thanks so much. Thanks so much for answering my question. This was a very easy to understand format. Another great workshop. Thank you very much. So I'll use those comments to sort of close out here and thank money management educators for the 2nd of Thursday. We got one more coming up next Thursday. Tune in with us. Remember, every Tuesday and every Thursday are webinar days for Fuel. We have one more Thursday that's dedicated to financial topics. Make sure you check our website for registration and find out all the deets on that. Tim, thank you so much.
Thank you, Corey Joe.
Gary, thank you.
Pleasure.
Are you missing golfing right now? You wish you could golf?
Yes, thanks for bringing it up. I'm coming to Wisconsin, though, to play because I can play up there anywhere I want. So.
Come on up here. And Andrea, thank you so much for all you do to make this work behind the scenes and for making sure those questions get answered for us. Thank you to everyone who participated and tuned in to today's webinar. I see you guys. Great questions. Can't wait to see you next Tuesday and next Thursday. Everybody have a great long weekend.
Thanks. Take care.
Thank you.